The Federal Reserve left interest rates unchanged at today's meeting.
Now, this comes in spite of inflation accelerating last month and remaining above the central bank's target rate. But the Federal Reserve increased interest rates 7 times in the past year in an effort to mitigate inflation, and officials opted not to raise rates today or when they met in June.
The Bureau of Labor Statistics reported last week that consumer prices climbed 3.7% last month from a year prior. That's nearly 2% higher than the Federal Reserve's target inflation rate.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Jill Schlesinger joins us now here in Studio 57, and Ed O'Keefe is also with us from Washington. Jill is a CBS News business analyst. Ed is a CBS News senior White House and political correspondent. You know them both very well.
The White House has been trying to stress that they are being successful in their monetary policies, even though we know that the Fed is separate and independent from the Biden administration. What type of word are you getting from the Biden administration and how they feel the economy is doing?
Well, nothing official on this decision so far, even though, as you guys point out, it was expected. Look, White House continues to argue, the president does, that his economic policies are working. And that ultimately the economy is going to be better off once all the legislation that was passed in the last 2 years or so is finally implemented. But if you look at our polling from over the weekend, I think there are still signs that voters, at least, don't necessarily agree with the president unless they've begun to hear and learn more about what exactly it is he's been up to. Nearly half of voters and most independents in our poll said they're worse off financially than before the pandemic. We have not seen a rebound since the pandemic started to wane, and people's measures of their financial success or security haven't returned to those pre-pandemic numbers. Look at that, 45% saying it's worse off today. Now, of those that have started to hear, though, by the way, at this number here, if you think things are worse off today than they were last time, no surprise, you are not necessarily supporting President Biden. You are more likely to be supporting the Republican candidate, which, presumably right now is former President Trump or somebody else. So that's an issue for the White House. But the more people start hearing about what it is the president's been up to in the economic space, especially among independents, according to this poll, they are perhaps more likely to be, they're more likely to be backing him. That's the word I was looking for. That if they've heard about the infrastructure plan, if they've heard about the Medicare plan to negotiate drug prices, if they've heard about the general economic push by this White House, they're more likely to be supportive of him, which is why you're going to continue to hear him talk about this week in and week out in different ways to ensure that that number, are you better off, and general perceptions of the economy, separate and apart from whatever the Federal Reserve is doing, helps improve his standing on this question of, are your finances in good shape?
Well, thanks, Ed. Jill, I'm wondering if it's possible at all to, put away the political part of this conversation, just looking at the numbers, which is what you do. Should people feel good about this moment in the economy, about today's decision by the Fed?
Well, I think there's a few different things to consider. I mean, we talk about broad-based trends, right? And the Federal Reserve itself in the statement say that economic activity has been expanding at a solid pace. Also at this meeting, there are economic projections from Fed officials, and they are projecting a 2.1% expansion of the U.S. economy this year. So much better than anyone had expected, right? Because when we look back to the beginning of the year, economists were saying, we're going into a recession, life's terrible. But what we do know is the economy is expanding. Labor growth is certainly slowing down, but it is still solid. And so the idea that you're worse off today than maybe during the pandemic might also have something to do with the fact that there was stimulus, there was money coming in, and we had a lot of benefits. What is clear to me is the Fed, when they do these projections, they don't know much more than any of us. They're looking at data. They're trying to predict. They are not mathematicians where at equal sign is at the bottom and they know what's going to happen. Their guess is as good as ours. So what we know is the economy continues to grow. Interest rates will stay higher for longer. Really great news if you're a saver, really rotten news if you're a borrower. But overall, this economy has performed extraordinarily well throughout the pandemic and post-pandemic.
Yeah, and we are outperforming so many other nations when you look internationally at how we've been able to weather what is really a crisis financially across the globe. But when you talk about the problems if you're a borrower, let's talk about the impact that this is going to have, particularly on people who are looking to buy homes, people that have high credit card debt, other debt. This is good news for them, right?
Well, okay, if you have debt, interest rates are still high, right? So if we're servicing debt, if you've got an outstanding balance on your credit card, it stinks. You are still contending with very high interest rates. If you're going to get a new auto loan, it's going to be more expensive. And I think that these short-term interest rates that the Fed does control, those are the ones that people really react to quite quickly. But as you mentioned, mortgage rates are still high at around 7% for a 30-year fixed-rate mortgage. Here is the weird thing about the housing market, okay? Yes, the Fed raised rates, all interest rates were increasing, mortgage rates went up. The housing market activity slowed down, but prices have not. They are still incredibly high. Yeah. And the reason is something that's a pandemic hangover, and that is that people who bought homes during the pandemic and financed them with 2.5%, 3.5% 30-year fixed-rate mortgages, they are not putting those houses up for sale. There's no way. And if you refinance and you're below 4%, why on earth would you list your home for sale? So I think the housing market is in a very strange position.
I talked to these.
There's no supply. And builders can't build them fast enough. So that's going to be a part of the market we're going to keep an eye on because it is so strange. We've never been in a situation like this.
And materials are expensive, too. So, Jill, is this it for rate hikes? There's some rumors that next year the rates could come down. Is that founded on a realistic expectation?
When I'm looking in the projections from the Fed itself, they think there's going to be one more increase, one more quarter point this year. I'm not so sure. I got my little Fed decoder ring out. You know, I look at it on the side. And what I can say is that it's going to be hard for them to raise interest rates right now because there's a lot of uncertainty. Next year, they're factoring in a couple of rate cuts. I also wouldn't count on that. I think these rates are staying higher for a lot longer than the market and individuals expect.
You know, I'm sorry, I just have to ask one other question, Jill, because I love your point about they are not prescient. They have the data and they just go through it like anybody else who can crunch the numbers. But one of the other things that's affecting people at home, our viewers, are the high gas prices. And again, that's something that you can only look at the numbers and you can make projections. But what do you see in the future?
Well, listen. It is really tough when you go to the pump and fill up because all of a sudden you're like, oh, no, not this again. And the Fed is aware of that. But, you know, we've seen a 30% increase in crude oil since June. We're now above $90 a barrel for crude oil. That translates into a big bump at the pumps. The issue is the Fed is watching that because they know that the big increase is due to Russian and Saudi Arabian production cuts. And they don't see that as a long-term issue. They're hoping that that gets reversed. If we see those energy costs feed through to the rest of the economy, where other prices are going up, where jet fuel is rising, and other things we're seeing a bump up in inflation, the Fed will act. But I think right now they could take this pause. This is a good moment. I'm happy if they pause for the rest of the year.
We'll see. I'm with you.
So are we. Jill, thank you so much. And also thank you to Ed in D.C. Appreciate you.